Hello traders and investors. I am Shantanu Nakhate, the founder of Quantway Consulting LLP. Since mid-October 2020, I have been working on designing and implementing custom trading systems to manage and grow my own capital. I hold a master's degree in Systems and Control Engineering from IIT Bombay, and I have had the privilege of working in India and Singapore earlier in my career for various MNCs in the R&D department. So that was a brief introduction about me. In this video series, we will explore the fundamentals of quantitative trading and take a hands-on approach to backtesting with help of AI. We will begin by developing Python code for backtesting a mean reversion long entry strategy on a specific stock, and then we shall analyze the resulting trading bot data to find the key trading parameters. Next, we shall position size the trades, manage overall capital, and rerun the backtest. We shall then optimize the trading parameters to improve the performance and evaluate the strategy using Pyfolio and find backtesting metrics. We will also analyze the equity curve, which tracks net capital, cash available, and in-market capital over the trading period. By the end of the series, you will have clear understanding of how to find actionable insights from historical data, perform a backtest, and build robust data-driven trading strategies. Before we continue, please take a moment to read the disclaimer and the risk warning. Quantitative trading involves using mathematical models and algorithms to identify and capitalize on trading opportunities. These algorithms rely on data analysis to execute trades systematically and efficiently. In simple terms, quantitative trading can be as versatile as you make it. All you need is a robust data set that can be analyzed and quantified. The process typically starts with forming a hypothesis or extracting insights from data. This hypothesis helps you define a set of trading rules which can be then tested on historical data, either the same dataset used to generate the hypothesis or a separate dataset which is unseen for validation purposes. Once the trading rules are applied to the historical data, the next step is to develop performance metrics to evaluate the success of the strategy. By systematically quantifying your rules and results, you engage in quantitative trading. Quantitative trading encompasses a wide range of strategies designed to leverage data-driven insights. Let's explore some of the key approaches. First is the statistical arbitrage. Mean reversion strategy assumes that the price of an asset will eventually revert to its historical mean. By identifying deviations from the mean, the traders can capitalize on the price action. Pair trading involves pairing two similar companies, often within the same sector, and exploiting the price discrepancies between them. For example, the chemical sector has two companies with comparable products and raw materials. They may experience relative price differences. If one of the stock is trading significantly higher than the other, then we can establish a proportional pair trade, buying the undervalued stock and shorting the overvalued one to profit from the eventual convergence. High frequency trading such as market making involve placing simultaneous buy and sell orders to profit from the bid-ask spread. Another common HFT approach is latency arbitrage, which exploits the minor timing differences in the market data feeds across the trading platforms. These strategies require cutting-edge ultra-fast hardware and robust software to operate at extremely high speeds. Trend following strategy uses moving averages to identify trading opportunities. A popular approach is to buy when the short-term moving average crosses above the long-term moving average, signaling a potential uptrend. Momentum trading focuses on stocks that exhibit strong price momentum in one direction, often supported with a higher trade volumes. Traders aim to ride the trend as long as the momentum persists. Machine learning involves supervised learning and unsupervised learning. Supervised learning uses historical data to train models that might predict future price movements. Common techniques include regression analysis, decision trees, and neural networks. Unsupervised learning identifies patterns and relationships in data without defined labels such as clustering and anomaly detection. Sentiment analysis focuses on understanding market sentiment through news and social media data. By analyzing news articles, financial reports, and social media trends, traders can gauge the overall mood of the market and make informed trading decisions. For example, detecting a shift in social sentiment towards a specific stock or sector can reveal trading opportunities ahead of price movements. Each of these strategies highlight the diverse possibilities within the quantitative trading. Quantitative trading relies on various types of data to identify opportunities and develop strategies. These data types include market data, fundamental data, alternative data, and news and events. Market data consists of historical prices for stocks, bonds, commodities, and other financial instruments. It also includes trading volumes, bid-ask spreads, and other market-related metrics that help traders analyze past performance and current trends. Fundamental data focuses on financial health and performance of the companies and economies. It includes financial statements, example, the income statements, balance sheets. Then it has economic indicators and corporate actions such as dividends, stock splits, or mergers. Alternative data goes beyond traditional financial metrics to provide unique insights. This can include social trends such as trending keywords or popular products and services. Satellite imagery can be used to monitor shipping activity or analyze parking lot usage to gauge the retail performance. These unconventional data sources offer valuable perspectives that are not readily available through standard datasets. Real-time news and events data provides insights into market sentiment and potential price movements. Breaking news, geopolitical developments, and other impactful events can influence the market conditions and create trading opportunities. By integrating these diverse data types, quantitative traders can enhance their analysis, uncover patterns, and develop robust trading strategies. I have selected S4 Camarilla pivot crossover on a daily time frame to test a mean reversion long entry strategy. For this analysis, I am using HDFC Bank stock. Specifically, if the stock price falls below the S4 levels of the daily time frame during the trading hours, the trading bot will purchase shares based on a predefined position size. The stop loss is set at 5% below the buy price and target is set at 5% above the buy price. The 5% values are initially chosen arbitrarily to provide the starting point. As we proceed with the analysis, the data will guide us refining these numbers. The strategy will be used for backtesting to gather data, gain insights, and evaluate the trading strategy performance. To get started, here is what you will need. A historical data file of stock prices stored in a CSV file. This file should include the following columns: date, open, high, low, close, and volume. A Python environment to run your code and analyze results. I am using Spider and Jupyter Notebook to develop, debug, and execute Python code. AI tools like Copilot, ChatGPT can be very useful for generating Python code. I am passing the following input to Copilot to generate Python code for calculating the Camarilla pivots and creating a buy signal based on S4 levels. The code should use the previous month's high, low, and close values to calculate the S4 levels for one day. A buy signal should be generated when the stock price low for the day is below the S4 levels, with a stop loss defined by the variable stop loss in percent and the target levels for booking the profits defined by the variable fixed gain percent. The final output should include various necessary data such as the target hit date time, stop loss hit date time, open high low close values, 5-day best gains, 10-day best gains, and 15-day best gains after our buy signal. This will help us create statistics around the buy signal defined in our strategy. I have opened Spider IDE. After some fine tuning, I completed the Python script named s4 breakdown sample.py. Upon running this code, you can view the variables in the Variable Explorer. In the define section of the code, I have defined the variables stop loss percent, fixed gain percent, and hold time for fixed gains. The hold time for fixed gains is the maximum period we shall wait until either the fixed gains or the stop loss is triggered. Otherwise, we will book the profits or loss at the end of the hold time using the closing price of the final day as the trade's closing value. Once the code is executed, a CSV file will be generated as output. The CSV file contains the trades executed by the trading bot based on the parameters we defined earlier. Now let's closely examine the CSV file to verify the trading performance of the bot. The CSV file includes the following columns: date time. The date time is the date when the buy order was placed. Open, high, low, close, and volume. These columns indicate the daily values for the respective trading day. Month column shows the month and the year when the trading occurred. S4 values indicate the Camarilla pivot levels for that day. Buy price is set as same as the S4 level. stop loss is set at 5% below the buy price. For instance, if the buy price is 227.446, which is our example case, the stop loss is calculated as 0.95 times 227.446, which is equal to 216.0737. So the stop loss hit date is the date when the stop loss was triggered and the position got closed in loss. Stop loss gains indicate the stop loss percentage. Days to stop loss indicate the calendar days from the buy point when the stop loss was triggered. Fixed gains column lists the gains either profit or loss after the trade was closed. Sale date indicates the date of closure of the trade either in profit or loss. The days to gain columns indicates the duration of the trade was open before the fixed gain was realized. Additionally, there are columns listing the maximum gains if the stock was hypothetically sold at the highest price within 5 days, 10 days, 15 days, and so on from the buy price. Now let us open the HDFC Bank charts from the trading view and verify the data generated by the trading bot. In our selected test sample, the trade occurred on 27th of October 2010. The buy price is 227.446. The stop loss is correctly calculated as 216.07 and the target is 238.81. By examining the charts of HDFC Bank, we observe that the target level of 238.81 was surpassed on November 4, 2010. Since the stop loss was not triggered before this date, the fixed gain column, which records the profit or loss booked by the trading bot, is set at 5% for this trade. The maximum gain in the first 5 calendar days occurred on 1st of November. The high price on 1st of November was 236.6. So, let's open the calculator to verify the maximum gains in 5 days. So, we will divide the difference, that is 236.6 minus 227.44, and it will be divided by 227.446 and multiplied by 100 to get the percentage returns, and this gives us the value to be 4.0246915, which matches exactly to our trading data provided by the trading bot's output. So I have verified all such rows, various such rows in similar manner. This type of verification helps you to understand if the code you develop is functioning as desired. Let us take a first look at the trading statistics generated around the buy point. Selecting the fixed gain column, we see that the average gains are 0.83% with a total of 239 trades performed. The sum of the fixed gains is 200%. Selecting the dates to gain column, we can see that on an average, the trades were closed within 13 days from the buy price. Days to stop loss column selection shows that on an average, the stop loss was triggered within 15 days. Max gains columns of 5 days, 10 days, and 30 days show 5 days gains were averaged at 4%, 10 days gains averaged at 5.4%, 30 days gains averaged at 8.78%, and 120 days gains averaged at 18%. This gives us a valuable insight into the performance of trading bot based on the defined strategy. Trading success revolves around 3 key parameters: the position size per trade, the time for gains, that is the hold time, and the amount of gains. Imagine this to be a triangle with area of triangle representing the gains, either loss or profit. If we deploy many such strategies simultaneously, then it shall lead to generation of many such small triangles. Such small triangles collectively shall form the gains and the equity curve for your quantitative trading. Now let's implement this trading strategy by defining the position size, initial capital, and maximum capital usage at any given time. We will start with an initial capital of 100,000 INR in cash. The fixed position size will be 10,000 INR, which is 10% of the starting capital. Additionally, we will limit the maximum capital usage to 80% of the net capital. The big blue box represents the net available cash. When a trade is executed with a defined position size, the net cash will decrease and move into the market. The cash portion of the capital shall reduce by equivalent amount as if this capital now is moved into the market. After the trades are closed, whether they result in profit or loss, the capital will return to cash from the market. The net capital shall be the sum of the available cash and in-market capital. The in-market capital shall be calculated based on close price of the day multiplied by the number of shares held. The EQ curve sample.py executes the trading activity based on the position sizing logic. For each trade, 10% of the initial capital is used, with maximum capital usage limited to 80% of the total initial capital. The trading activity is performed using the buy and sell signals from the trading bot's CSV file. To determine the daily net capital value of the portfolio, we use HDFC Bank Daily Open High Low Close Values CSV file. After running the Python script, we obtain the CSV file named as HDFC Bank Daily Capital Analysis. This file details the trading activity. We can see date-wise capital used for trading, which is labeled as in market. Then we have the cash available and net capital values for each day. For example, the first trade happened on 24th of July 2000. We can see that the in-market capital was around 9964.72. Cash available was 90,000 and total net capital was around 9964.72. The trade got closed the very next day in profit, and we can see that in-market capital was 0, cash available was 100,499.47, and so was the net capital. By plotting the net capital chart, we can observe how the capital has grown over the years. Notably, by the end of the trading period, the capital had grown by 17% on absolute basis, while the trading bot achieved approximately 170% gains based on the position size basis. I have passed the Excel data to data wrapper and created a chart visualization for minus 5% stop loss, 5% fixed gains and 48 days hold time. We can hover the chart and see how the in-market, cash available and net capital values varied during the trading period. Next, let's optimize the parameters by tuning the hold time, stop loss percentage and fixed gain percentage. After running the evaluatestrategy.py Python code, we obtain a CSV file that shows the strategy evaluation results. Let us open the output CSV file. In this process, I have varied the stop loss percent, fixed gains and hold time to get the output as the sum of fixed gains, average fixed gains and average R multiple. The R multiple is the risk to reward ratio per trade. Averaging the R multiple values across all past backtested trades gives us the average R multiple for that particular input setting. Upon examining the results, we see that the average R multiple graph has a high point at iteration number 22. By selecting the iteration number 22 settings of minus 3% as stop loss, 18% of fixed gains and 60 days of hold time, we might achieve better gains, lower drawdowns and best efficient capital usage. Additionally, another promising iteration is the iteration number 96, which has settings of minus 12% for stop loss, 18% for fixed gains and 120 days for hold time. This iteration has relatively higher average R multiple and has similar higher fixed gains. We will now run the Python code to generate the daily equity curve and then pass this output to Pyfolio for finding the performance metrics for the backtest. Pyfolio is a readily available online backtesting library. You need to install it in a separate Conda environment. Once installed, run the code in the Jupyter Notebook. I have opened the output file. First, I have passed the HDFC Bank's close price returns data to Pyfolio to understand the stock dynamics. The data available spans from May 9, 2000 to October 7, 2024. Here are the backtest performance metrics. Annual returns were approximately around 18.7%. Cumulative returns was 61 times the starting capital. Annual volatility was around 29.9%, Sharpe ratio was around 0.72, and max drawdown was around minus 55.4%. The severe max drawdown of minus 55.4% indicates extreme fluctuations in the portfolio's net value throughout the trading journey. This can be really very hard for a typical investor to tolerate. Further, there's uncertainty about the stock's recovery from such significant falls. The scenario highlights the advantage of quantitative trading or setup-based trading, which maintains the linearity of the equity curve and helps to reduce the portfolio volatility. The underwater plots reveal several occasions of drawdowns exceeding 30%. Next, I have passed the equity curve of the net capital generated by the trading using the settings of minus 3% stop loss, 18% of fixed gains, and 60 days of hold time. The annual returns in this case were 1.6%, cumulative returns was around 46.4%, and the max drawdown was limited to only minus 7.1%. Focusing on the period from 2008 to 2012, when the buy and the hold strategy faced 55.4% drawdown, our strategy settings resulted in approximately 15% gains. The rolling Sharpe ratio reached as high as 4, and during the market crisis, the strategy's underwater level was less than 7%. Lastly, I tested the settings of minus 12% stop loss, 18% fixed gains, and 120 days hold time. Annual returns in this case were 3.3%, cumulative returns was around 117.5%, and max drawdown was around minus 17.2%. This setting has achieved much better overall returns at the cost of higher drawdowns. The cumulative returns graph shows a stable and upward trending equity curve throughout the trading journey. During the 2008 to 2012 market crisis, the portfolio's underwater level was less than minus 8%, and the gains were around 23% during this period. So that was a brief overview of a quantitative trading strategy, backtesting, parameter tuning, and performance analysis. So this opens up an infinite opportunity land for you. You can use this strategy to improve your asset allocation by implementing a strategic backtested approach. So stay tuned and subscribe to our channel to learn more about quantitative trading. Do visit our website quantwayconsulting.com to book an appointment, read our blogs, and much more. Share this with someone who would find this useful.